Anglo American just sold its entire Australian steelmaking coal portfolio for up to $3.875 billion. And the mainstream read is straightforward: a clean exit, a strategy completed, a balance sheet strengthened. But the investors who bought Anglo American as a diversified mining major are now holding something the diversified miner thesis was never designed to price. That thesis rested on a specific logic: exposure spread across coal, copper, platinum group metals, and diamonds gave Anglo a commodity cycle buffer that pure plays could not offer. Diversification was not incidental. It was the reason the stock sat in generalist mining allocations rather than thematic or critical minerals mandates. The BHP bid in 2024 forced Anglo's hand, and the restructuring that followed was framed as defense. This coal sale is not defense anymore. It is the last structural piece that closes the diversified chapter entirely. What the exit actually does is dissolve the premise that justified the position for a specific class of holder. Generalist miners hold Anglo because the portfolio correlation to any single commodity was dampened. Strip steelmaking coal, a commodity whose price cycle moves differently from copper and moves very differently from platinum, and the dampening mechanism disappears. The investors who price at Anglo on a blended commodity exposure model are now holding an asset that no longer fits their model's inputs. That mismatch between the stock's new identity and the identity priced into current holders is the real tension this sale creates, and the market has not yet fully settled who replaces them.
The sector reclassification question this sale forces is not subtle. Anglo American, post-coal, becomes a stock whose earnings base is dominated by copper, platinum group metals, and diamonds, and that combination does not map cleanly onto any existing peer group in the way diversified miners do. The copper angle is the one getting the most attention, and for a structural reason. Copper is the metal most directly exposed to electrification demand, and thematic capital chasing that demand has been accumulating in a short list of liquid names: Freeport-McMoRan, Antofagasta, Ivanhoe. Those stocks trade at valuations that reflect not just current copper prices, but the forward scarcity premium that energy transition capital has assigned to undeveloped copper supply. Anglo, with its Quellaveco operation in Peru already running, and its copper exposure now proportionally larger inside a smaller portfolio, is newly legible to that capital class in a way it was not while coal diluted the picture. The countersignal, and this is the point most sector rotation analysis misses, is that Anglo's PGM exposure runs through its stake in Amplats, and platinum group metals are in a structurally different demand story from copper. PGMs face the long-run pressure of catalytic converter substitution as electric vehicles displace internal combustion engines. That exposure is not a critical minerals growth story, it is a managed decline story with a contested timeline. An investor buying Anglo for copper exposure is simultaneously buying PGM exposure that thematic copper capital specifically wants to avoid. That creates a valuation wedge. Pure-play copper peers like Antofagasta carry a multiple that reflects clean copper transitioning positioning. Anglo, carrying the PGM drag alongside its copper assets, cannot command the same multiple even after the coal exit, unless it moves on Amplats next. The coal sale closes one discount, the PGM overhang opens a different one, and the market is now pricing which institutional holder decides to press that question.
The deal's structure carries information that the headline number obscures. The $2.3 billion upfront payment is confirmed capital. It lands on Anglo's balance sheet and is already being priced by the market. The remaining $1.575 billion is a price-linked earnout tied to steelmaking coal prices, payable only if coal markets cooperate over the earnout window. What the earnout structure signals is that Dhilmar, the vehicle of Indonesian billionaire Alexander Ramili, and Anglo could not agree on a single clearing price for the coal assets because they disagreed on where steelmaking coal prices are headed. Anglo, eager to exit and complete its restructuring narrative, accepted a structure that front-loads certainty and backloads upside and no longer wants to manage. Dhilmar, betting on sustained or rising metallurgical coal demand from Asian steel production, accepted the earnout as a mechanism to pay less upfront and capture the commodity upside itself. The participant timing gap here is observable. Anglo's institutional holders who were waiting for the strategic restructuring to complete, the ones who held through the BHP bid defense on the thesis that a simplified Anglo would re-rate, have now received the signal they were waiting for. The $2.3 billion upfront is the trigger event, but the earnout means the full $3.875 billion story requires steelmaking coal prices to perform over an extended horizon that Anglo itself has just chosen to exit. The holder's position for the re-rating event and the holder's position for full value realization are not the same capital class, and their exit windows are not the same. The The institutional holders who moved first, accumulating through the restructuring period on the simplified portfolio thesis, now hold an asset that has delivered the catalyst. Whether they rotate out at this point or hold through a potential Amplatz resolution is the positioning question the earnout structure makes impossible to read from price action alone. The $2.3 billion is in the stock, the $1.575 billion is not, and its presence in the deal terms is a standing reminder that Anglo's clean break from coal has a conditional asterisk attached to it.
The risk structure of Anglo American has changed in a way that is directionally clear but quantitatively unsettled, and that gap is where the most consequential repositioning is still outstanding. Steelmaking coal carried a specific beta profile, correlated to Chinese steel output, Asian infrastructure spending, and emerging market industrial cycles. Removing that exposure reduces Anglo's correlation to the EM industrial capex cycle and increases its correlation to electrification demand and developed market transition capital. That is not a marginal rotation. It is a beta shift that moves Anglo out of one volatility cluster and into another. The implied holding period for these two risk profiles is different. EM industrial cycle exposure rewards a commodity cycle horizon of 3 to 5 years. Electrification transition exposure rewards a structural horizon of a decade or more. The ESG capital dimension compounds this. Steelmaking coal, despite being categorically different from thermal coal in its industrial function, was sufficient to keep Anglo outside the screening criteria of a meaningful share of ESG-mandated institutional capital. That exclusion created a persistent discount, not because Anglo's fundamentals were impaired, but because a structural buyer class was blocked from the stock. The coal exit removes that block. The question is not whether ESG-screened capital can now enter. The question is whether the reallocation process has already begun, or whether it is still waiting on index reclassification and mandate review cycles that lag the deal announcement by quarters, not days. The threshold that confirms the re-rating is not the deal close. It is the first index rebalancing cycle in which Anglo is reclassified under screening frameworks as a non-coal miner. Until that classification update propagates through the passive and ESG-screened fund universe, the potential buyer class exists in principle but not in active flow. The Amplatz question, which Anglo has not yet resolved, runs alongside that timeline, and if PGM exposure continues to suppress the copper transition multiple, the re-rating that the coal exit theoretically unlocks may still arrive later than the deal announcement suggests. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.